Well, this is the Monocle Banking Podcast. I'm Michael Avery, and today we're taking our cover on the shifting tectonics of risk, climate risk, systemic risk, and the rising cost of transferring it in an increasingly volatile world. Well, scrolling through my weekend news feeds, I stumbled on a quote that made the hair on the back of my neck stand to attention. If insurance is no longer available, other financial services become unavailable too, and capitalism as we know it ceases to be viable. Now, the man who was quoted was none other than Gunther Tallinger, who's a board member of Allianz, a little firm with just $1.1 trillion in non-bank assets. So it's not a hippie chained to a bulldozer at a climate rally. That's the guy running risk for one of the world's biggest insurers. And some might argue that Tallinger is wrong and that insurers and reinsurers are blaming climate change to cover up for decades of underpricing risk or poor portfolio management. But what if he's right? What if he's uncomfortably trousers around the ankles right? Because insurance used to be the kind of quiet stabilizer of capitalism, but today it really is front and center in the battle for economic resilience and continuity. When global reinsurance markets sneeze, entire economies can catch a cold. Well, joining me to unpack the state of South Africa's reinsurance and insurance markets this year is Jane March, Chief Executive of Guy Carpenter South Africa, which is a leading reinsurance broker and part of Marsh McLennan. From facultative reinsurance in the mining sector to why entire regions are becoming uninsurable. This conversation will cut to the core of what it means to protect value in an era where nature increasingly seems to be writing the rules. Jane, welcome. It really is good to have you on the show. Just tell us a little bit more about how you became involved in the insurance industry.
Thank you, Michael. It's good to be here. I got involved in the insurance industry, as most people did back in the day, by accident, but it's been a very interesting journey. I've focused on the direct side for many years, insuring direct clients. I was heavily involved in mining and many of the big corporate industries, and then I moved over to the reinsurance sector within the Marsh McLennan Group almost 5 years ago.
To start us off, maybe you can just give us an overview of the state of the insurance and the reinsurance markets in South Africa today in 2025. What's keeping you up at night?
So I think the reinsurance and the direct markets are both healthy at the moment, helped somewhat by a lack of extreme cat events. We had 3 bad years with the COVID losses, then the riots, and then the KZN floods, but things have stabilized. People are making some returns, retentions remain robust, so the losses aren't going through to the reinsurance market. So I think it's been a better space than it was prior to that. Motor loss ratios remain a challenge for many of the direct insurers, but they are getting that under control. Largely, a lot of the vehicles on the road also uninsured, which doesn't help in terms of profitability.
I've been a long an advocate for mandatory third-party insurance. Yes, it adds a layer of cost, but if you're insuring the whole pool, well, that's the way insurance works. You bring the overall cost down and you just build and deepen resilience in the system. But I don't want to get ahead of myself. We're obviously seeing headlines like regions becoming uninsurable, and we see what happened in the Florida Keys, for example, with the hurricane season there, and you read stories about reinsurers being very hesitant now to insure in markets where what were once 1 in 100-year events are now becoming 1 in 10-year events. And Gunther Tallinger from Allianz certainly didn't mince his words. Are we seeing familiar or similar pressures in South Africa?
I think we have been fortunate the last few years. We did experience reinsurance significant hardening of rates and increasing of retentions, i.e. keeping risk on cedents' balance sheets. But yes, losses are shifting, they are becoming larger, and it is about whether they can be priced and actually underwritten.
And I mean, we had, a Cyclone Freddy in Africa. You've seen globally the Canadian wildfires as well, almost all over the world, these major global catastrophic events. How does that impact the local risk pool and reinsurance premiums here in South Africa?
So the reinsurance market is a global market. What we are seeing now in the new normal is catastrophic losses. We view those in excess of $100 billion are now $130 to $140 billion a year is becoming the new normal. The market is able to absorb these. So it depends on the aggregation of events for the entire year for the reinsurers. And luckily, South Africa has had a few risk-free years. So that has helped us and to insulate us against the global market. But the global market overall is in a healthy position. Reinsurers have returned to profitability. and showing improved return on equity, which does help stabilize the pricing.
Are we seeing a retreat at all from certain lines of coverage or geographic regions within South Africa? For example, maybe floodplains or low-lying areas around the Durban region where we've seen an increase of flooding type hurricane, almost hurricane style events. Are there any categories that might be flashing orange or red for you at the moment?
Yes, I think the direct insurers are underwriting those risks a lot more closely, either putting limits on the flood losses. In some instances, potentially insurance will not be available. And it's about how you manage those events and the price you charge for them. So it is a shifting market and there's more focus on the risk. And also for insurers, it's about managing the aggregation, not having too much accumulation in a certain area that is prone to catastrophic events.
That's an important point, how they navigate this. And I think as insurers look to navigate systemic risks, be it climate or infrastructure failure or social instability, we saw the July riots as well, AI-driven kind of smart pricing is being touted as a game changer. Are you seeing that starting to be embraced and introduced in the way insurance is written and priced?
I think not necessarily AI at the moment, but a lot more focus on geocoding of risks. So getting the exact location of the risks and being able to review that against the potential flood loss, wildfires, another big risk as well in our country, and lesser so the earthquake, which is more modeled and more understood here. So definitely a focus on where the risk is located and pricing for that individual risk.
Speaking of the models, what role are climate models and that kind of scenario analysis playing in underwriting decisions at the moment? Do you think South African insurers are ready for the sophistication that reinsurers are demanding?
I think definitely it's a journey. South African insurers have done a lot in terms of the geocoding, understanding the aggregation, looking at specific areas of high risk. Data evolves every year, and it's about improving that and understanding the risk more.
I have had it put to me that a lot of what's going on in the climate space is hysteria masking poor underwriting. And, some argue that insurers and the reinsurers are blaming climate change to cover up for decades of underpricing risk or poor portfolio management. Is that fair?
The insurance and the reinsurance market, it's a marketplace and it does go in cycles. When people are making money, rates tend to reduce, then there'll be a certain amount of losses and rates increase. But pricing going forward, I think, is very different from pricing looking historically. A lot of the models are based on historical losses. It's about being able to overlay the shifting climate that we're seeing and the larger losses and being able to overlay that on your models to ensure you have the correct pricing.
Whether it's a retreat or a repricing strategy, I think when reinsurers talk about maybe withdrawing capacity from high-risk areas like coastal towns or informal housing, I guess that could just be capitalism doing what it always does, avoiding poor returns. So one then questions whether it's really about climate risk or about shareholder risk appetite.
I think it's some of both. South Africa on the global stage, in terms of overall premium coming out of the South African market, is relatively small. If you look at the US, the hurricane season, there's a certain amount better modeled than South Africa. So they are able to price accordingly. And it's about being able to understand those risks and making sure that the price is adequate for the bigger losses.
When it comes to the protection gap, if you look at what's happening, if there is a withdrawal by the reinsurance sector, could it therefore maybe be contributing to creating a protection gap or growing the protection gap by retreating just when the world needs risk transfer the most? How do we grapple with this? Because it is a very knotty global challenge for the reinsurance industry.
Yes, it is. And the protection gap is largely, you've got a large uninsured section of the population, and it's about how you can protect them. As pricing becomes more expensive for these risks, then the protection gap can increase, and it's looking at alternative ways of protecting the uninsured part of the population.
When we come to what happened, I think most recently in Prospecton in Durban, the decision by Toyota's global reinsurers to sue for damages at Transnet level, at a local government and provincial government level, do you see this as the new norm? If local governments don't start reinvesting in their infrastructure to ensure that they can be more climate resilient, and ultimately, that's a cost then borne by taxpayers.
Yes, I think a lot of it comes back to risk management, and even the climate is changing, heavier downpours, potential flooding is an increased risk, but it's about being able to mitigate that risk when it happens, both from an individual business point of view and from a government point of view. Your stormwater drainage, is it adequate? Is it maintained? Is it kept clear? Fire breaks, all those type of things come into actually managing the size of the loss when these events do happen.
So, I mean, let's come back down then to facultative reinsurance, which is kind of a type of reinsurance in which a reinsurer evaluates and accepts or declines a single risk or a specific insurance policy rather than taking on a portfolio of risks. It's almost like a la carte reinsurance rather than the set menu. Why is it becoming such a critical tool for business continuity, particularly in sectors like mining and infrastructure and energy?
Insurance operates on the principle of risk sharing and pooling. So, what an insurer will do, while it may be happy to take on the more hazardous risks, it may want to buy a certain amount of protection for itself. So, the FAC insurance allows the direct insurer to put down a meaningful participation in the risk, but they would then purchase in the background some additional protection to mitigate the impact of a really large loss to that insurer and protect their balance sheet as well.
What are the capacity constraints that we're seeing in treaty reinsurance today that's pushing more movement toward fact layers in insurance? Are we seeing price gouging or is it genuine scarcity?
I don't think there's a scarcity of capacity. It's more around what is being retained by the cedants on their balance sheets. So retentions have increased with the hardening market after our 3 years of cat losses. Therefore, there is more being forced back onto the cedants to retain. So the reinsurers want to be there for the absolute volatility, not for the every year attritional storms. And we've seen that it has been working, which has stabilized the reinsurance market. So on certain risks, they will be retaining more, and hence the use of FAC just to protect their net retention.
Can you give us an example of a recent large scale project that would have stalled or been repriced without FAC backing?
I think a lot of I'm just giving a general mining is absolutely, and energy, because the volatility and the propensity for large losses when losses do happen. A lot of the construction projects as well, where you're talking big numbers and big potential for loss, those would be protected to a certain extent with facultative reinsurance.
Are we seeing this in obviously the REAP space was very much touted as a big success just from a public-private partnership perspective, but also because there were government guarantees. Are you seeing this play an important role in giving investors comfort to bring these kinds of projects to market and de-risk them?
Yes, definitely. One of the things that lenders will look at is the insurance in place and the strength of the balance sheet of the insurers who are underwriting those risks.
Often it will come down to innovation and the role of the private sector, and it's being touted as one of the key solutions for systemic risk in particular. What are some of the most promising innovations that you're seeing in the reinsurance or the insurance value chain when it comes to the role of the private sector to solve for some of these risks?
I think we are now looking more towards the parametrics insurance. It has not been allowed in South Africa previously, but we are now looking at it. That is where it is not a contract of indemnity like insurance is. It will be a trigger, certain rainfall event, a certain drought, and then there is a payout. A lot of this is driven by governments and public-private partnerships. And a lot of that is also on systemic risk or protecting the uninsured population.
So just maybe talk to me a little bit more about parametric insurance then, because I've heard of it being hailed as kind of the next frontier for building resilience in underinsured and high-risk environments like ours. Why hasn't it taken off more widely in South Africa, and what could shift that?
Initially, our regulator did not allow parametric insurance. It is not a contract of indemnity like insurance is, putting you in the same position as you were before the loss as far as possible. It is literally a trigger. So if the rainfall exceeds X or is below Y, there would be a payout. So you can insure crops against drought for that without having to assess the loss. So if there was a rainfall event in KZN, for example, there would be an agreed pricing, there would be an agreed structure, and in the event of the rainfall exceeding a certain amount, there would be a payout, which would help your uninsured populations to be able to get some benefit. And normally they are public-private sort of collaboration, and that's where we see elsewhere in Africa, there's a lot of
Hmm.
interest, and some have actually been used. to do this.
It obviously, though, relies on clean and very trusted data. I think weather stations or satellite feeds or the right seismic monitors, if it's going to be something
Yeah.
relating to an earthquake. I think in South Africa, though, trust in public data and infrastructure is probably shaky, to put it mildly. So who should be the gatekeeper of the trigger data, and how do you build trust in the system for parametric to grow?
I think as long as you specifically define it and there's a time and an event and a place, I think our monitoring of certain events is still good, our rainfall up or down, and you'd need to agree what stations, but I think we still have reliable data there.
Do you think that parametric insurance, especially in maybe agricultural coastal risks, could become more mainstream here, or is the uptake still too slow?
I think it's an exploratory phase at the moment, and it could be for certain specific sectors. I think the traditional insurance will always remain for more single risk sort of property, but definitely in the agriculture space, it's a lot easier to facilitate and to manage. And for the protection gap for governments protecting the uninsured population.
Let's talk systemic risk, things like grid failure. I know that was a big topic, or not that long ago. We were all talking about stage 16 load shedding and black starts, political unrest. We saw what happened in the July riots in 2023. I think water insecurity is a big emerging one, and we feel it certainly here in Johannesburg. We're at the sharp edge of that failure. What does that mean for the financial system writ large?
So systemic risk is challenging for the principles of insurance, which relies on the premiums of the many paying for the losses of the few. Insurance does not operate effectively when most or all of the pool of policyholders become claimants at the same time from the same event, like load shedding. If the grid was to go down, pretty much your whole insurance pool would be claimants. And the propensity for the huge amount of the loss there, it just would not work, and it would test the insurer's balance sheets. So it's about finding alternative solutions and thinking a little bit outside the normal principles of insurance.
And to my earlier quote of Challenger, you made that chilling point that without insurance, there's no mortgage, and without mortgage markets, really capitalism fails. Is that hyperbole? Is that a genuine market threat?
I think while insurance is sometimes viewed as a grudge purchase, if you think of the capital flows from the reinsurers after a major event into South Africa, it's often not thought of like that. It does get economies back on their feet. It does help people to recover post huge losses. So without insurance, the market would be a very different place following a massive loss.
And what are we seeing when we talk about SASRIA and state insurance? Have we recovered following the July riots?
Yes, I think SASRIA has recovered. They've done a good job. It was the biggest loss in many years, and I think it brought focus. But the state insurance is, I think, now being explored. Treasury put out a paper in the last couple of weeks about looking at potential disaster insurance as well. So that will probably develop into the future.
Yeah, I was going to ask you what your thoughts are on that, and whether a sovereign reinsurance fund or a disaster facility is needed in South Africa to step in where markets can no longer adequately cover the potential systemic risk that could occur.
Yes, I think if you look at the rest of the world, that is what has happened. The flood pools that have been established, that is the way it is going for those risks that the insurers are not prepared to carry wholly on their balance sheets. And that is how SASRIA started way back when.
If we were to look ahead to the G20 and the upcoming climate finance summits, what does South Africa need to be advocating for in terms of resilient infrastructure finance?
Well, resilient infrastructure underpins everything. It underpins the business, the economy. So I think it's getting that strong so that the economy and the business can grow.
And should we be calling for things like, catastrophe bonds or blended public-private risk pools specifically as tools for Africa, or is that still out of reach politically and economically?
I think public-private risk pools definitely. Catastrophe bond insurance is generally used where you run out of capacity in the traditional market. The traditional market is still the most cost effective, but for the really big loss limits that are required elsewhere for the hurricanes and that's where you see the catastrophe bonds being utilized more.
Right. And from your perspective, are companies waking up to this climate risk financing gap, or are we still too reactive?
I think companies are realizing, and yes, they are, things are changing, but what is the adequate pricing? What happens with the 1.5 degrees and temperature increase? What happens with the 3 degrees? What is the impact on the historical models? And how much do we need to price going forward? And that is very much an emerging field.
Yeah, and getting that right, getting that balance right, I think is going to be a really interesting area of future innovation and development. Before we move on, Jane, I'd like to bring in some thinking from a highly respected South African actuary, Rob Rasconi. He recently presented a paper on systemic risk in the insurance industry at an ERM seminar in Pretoria. And really what struck me was how grounded and practical his insights were, especially in the context of South Africa's insurance landscape. Rasconi argues that while insurers don't pose the same existential risk to the financial system as banks do, they can still significantly amplify systemic shocks, particularly in markets like ours, which are so tightly concentrated and unevenly regulated, and facing layered shocks from climate change, from infrastructure fragility, and the strain on the public balance sheet as well. And he proposes a fresh lens, a framework based not just on traditional solvency ratios or idiosyncratic risk models, but on how insurers and their asset concentration and liability mismatches and their operational fragilities and even their strategic choices can become amplifiers of systemic risk. So I just wanted to bounce a few of his ideas off you to get your take from a reinsurance leadership perspective. Rasconi makes the point that those traditional actuarial and prudential models are excellent at managing firm-level solvency, but not particularly helpful for spotting risks that affect the system as a whole. So from your vantage point to Guy Carpenter, do you think the reinsurance sector is doing enough to anticipate and model systemic risk transmission, especially in a market like South Africa?
I think we continually evolve. A lot of work has been done, but there is always room to do more and to develop it more.
Rasconi suggests that regulators and insurers alike need to think more broadly, not just about solvency and reserves, because we've got SAM, but about things like asset concentration, about liability mismatches or over-reliance on single counterparties. Are these indicators you think that the industry is meaningfully incorporating into its forward-looking risk assessments?
I think the counterparty risk is becoming more of a focus. We do have a robust both insurance and reinsurance market. And while we like to keep some of the premiums local, the risk pooling across various reinsurers, I think, is what is key, and spreading that risk so that the hit is not too much for the South African market to bear.
And, given the massive climate events of recent years, Rasconi's also called for a climate-adjusted systemic risk framework. And that strikes me as the direction that the industry and regulators kind of need to take. Just lastly, Jane, if you had to sit across from the FSCA or the Reserve Bank's Financial Stability Committee tomorrow, what would be the single most important change you'd suggest in how we monitor and respond to systemic risks emerging from within the insurance ecosystem?
I think there needs to be more conversation and partnering to look at solutions between the private sector, the insurers, the reinsurers, and the regulators.
But there you have it. That was Jane March, Chief Executive Officer of Guy Carpenter South Africa, reminding us that reinsurance is not really just a behind-the-scenes industry. It really is the bedrock or the fault line beneath our entire financial system, because without insurance, you don't get mortgages, and without mortgages, no credit. Without credit, capitalism as we know it really does cease to function. This has been the Monocle Banking Podcast with me, Michael Avery. Remember to subscribe, share, and join us next time as we continue to unpack the forces reshaping finance from the inside out. Take care.